Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today's stock analysis, sharing with all of you guys because it's available in portfolios that are publicly facing. It is a stock analysis on my new favorite company, honestly, Landbridge. It's an extremely interesting play. If you've read my Substack work on Gold Royalty Corp and my comparison that I did in the article with Franco-Nevada, there are very, very, very strong similarities between Landbridge and Texas Pacific Land Corporation, which is, is a quintessential example of the royalty type business model. James DeVolis of Horizon Kinetics and I discussed this company in particular, and it was a really, really great experience for me anyway, in terms of learning more about what the company does. So disclaimer, nothing that I say here is advice. I'm just going to give you my take on things and why it is that I have a strong thesis surrounding the company. If you do want to take a closer look, you can check out a portfolio that I run on eToro, the Crassus investment portfolio. It's kind of barbelled at the moment between deep value multi-bagger plays and some of these also multi-bagger opportunities over a longer period of time. Capital light asset backed inflation beneficiaries. Okay. So the company, they a recent company, okay, IPO. So there's not a lot of financial data from their public listing they're on, but I think it's a chance to get in at a ground floor opportunity. They have a financial sponsor and let's call it a sister company, Waterbridge. Okay. So they formed Landbridge, and what Landbridge is going to do and is doing is acquire and roll up land in specific locations in the United States. Waterbridge is a company that has a lot of pipeline infrastructure. They take water that is a byproduct essentially of fracking in different shale and oil production, and they transport that water for other uses. Okay, it's a nuisance where it is as a byproduct. You need to get rid of it. So they obviously have a business around that, and then using it to a higher and greater purpose, mainly through the cooling of data centers is where this thing is heading. So Landbridge acquires sites that are going to be very useful for collecting surface mineral royalty fees and various other on various operations that take place on their land. So it's mainly a resource. It's a royalty company through a variety of different resources, whereas Texas Pacific Land has started off and evolved into many different things over the course of the years. These guys have the advantage of seeing the success of Texas Pacific and specifically allocating and acquiring land in such a fashion that can maneuver the water, can have great revenues over the oil and gas and everything else that's produced on their land, easements, highways, and all that sort of stuff. But they also have this AI, the benefit of AI being in front of them and them being aware of it. So they can really start to become attractive, specifically for attracting these types of plays. So your AIs, your crypto miners, and all those sorts of things to put their data centers and their mining centers on their land, which makes perfect sense. About 40% of AI energy needs at the moment, at least when they're training in these data centers, is towards the cooling aspect. And so that's, of course, where the water comes in. All right, let's really have a look at the operational aspects of this business. So if you take a look at a stretch of Landbridge land, okay, over here on the right, here's some of the activities that can occur on that land. And of course, they're getting royalties and on the surface. So basically kind of like lease fees. I would suggest they're very similar to that. And then sales from the proceeds of the actual underlying production. So oil and gas, they get a clip off the top and a royalty agreement, and then they get surface fees for things like easements, solar panels, essentially renting that land. Data center, not only do they rent the land, but then they also get clips of the ticket for the pipelines and the water that runs from their company Waterbridge. And so it's really, really, really looking good. And if you're a data center, you need your contiguous land, you need all these things on the left, basically cheap and abundant power. Definitely nat gas at the moment in the US is the cheapest and most abundant form. Low cost power, access to the renewables, access to the water for cooling. That's the big one. Your fiber optics, and you need a landowner that is not only amenable to that, but the landowner here, being Landbridge, are actually attracting these guys to operate on their properties. That's what I really like about this thing. Okie doke. So another thing I really like, although they don't have a long publicly traded history, you can see that most of their revenues just come from simple surface use and royalty revenues. Okay, so they're not heavily exposed to oil and gas necessarily, not heavily exposed to any one particular type of thing, the sand mines that are extracted for the fracking and all that stuff. They got land, people use their land, and they get a clip of the ticket. And it's a wonderful, wonderful, wonderful business model. So it's so new, you won't even find it on Ticket Terminal. At least I couldn't find it. But on Coifin here, you can see stock price, your EBITDA over the last 12 months, the enterprise value. Okay, so just shy of $1 billion. EV to yield the free cash because if you're wondering why the enterprise, if you're wondering why the EBITDA is negative yet you've got positive free cash, it's because EBITDA doesn't take into account or takes into account non-cash expenses and all that sort of thing. So non-cash expenses that are added back and form free cash flow. So currently with a yield of 6%, growing like absolute wildfire. Let's take a look at the quality of this business. And I think this really sums it up. You guys have heard me talk a lot about the royalty codes, Texas, Franco-Nevada, Wheaton, Gold Royalty, all these guys. Well, they've put this together here, which is a really, really interesting chart. In the purple is the core peer. So that would be Texas Pacific, Tejon Ranch Co., which I've got another video on, et cetera, et cetera. Then you've got your gold streamers here, your Wheatons and your Francos. And if you look at like this, Landbridge just beats them all, at least on the pro forma. Obviously, that's subject to change. But if you look at their free cash margin, their EBITDA margin, and the growth that they've had, it's quite impressive. And I think it speaks to the multifaceted aspect of this business. They're not just typically a royalties over one asset or a couple of related assets, oil and gas, gold, silver, gold, copper, that sort of thing. But these guys really can expand and have call options on the uses of their land over time. It's a high margin, highly capital efficient and asset light business model. If that sounds familiar, that's because I've been obsessing about this sort of stuff. Fee-based revenue streams, but they get access to commodity price upside. So it's all looking like what I want to own in a highly inflationary environment. Look, here's your quarterly revenues, your quarterly EBITDA, and your cash flows here. Okay, cash flow margins are what it's all about here. Have a look at that type of margin. Truly spectacular. The leverage initially is to do the acquisitions, and then they did the public offering as a float, and then paid down a lot of that debt. How are we going to value this thing? Very, very difficult to be precise, so we can't be precise. But what we can do is we can look at a peer, Texas Pacific, and if we go back over the last 24 years, they've been able to grow their revenue ridiculously well at like 37% CAGR. And they've been able to do the same thing on their EBITDA because it's basically the same thing for this type of business. And the market multiples you can see at the top here in terms of EV to EBITDA and then market cap to free cash flow. Now, I'm not going to use, they're a bit aggressive. I'm obviously not going to use those, but just to get an idea, comparing it to Texas Pacific, Landbridge, over the next 3 to 5 years, the CEO is giving some guidance and said, look, this thing can comfortably get somewhere between 200 to 300 million in water royalties, get roughly 50 million if they can land a data center on their land, which doesn't seem particularly outrageous over the next 3 to 5 years. 50 million oil and gas royalties, and obviously they can continue to grow these over time. So let's say somewhere between 350 to 400 million in revenues in worst case, maybe 5 years. Okay. TPL at the moment, so they've done over the last 2 years, they've been over 600 million per year, growing their revenues. If you shrink the amount of time we take the revenues, the growth rate is lower at around 14%. 14% CAGR. Goodness me, too excited. 18 billion of enterprise value and a history of enterprise value to revenue of 20x, okay, which is a bad metric, but it's just, we're getting started here. Landbridge could reasonably be valued at about 8 billion. How do you get that? Because if they're getting 350 to 400 million in revenue and you can reasonably pay 20 times the revenue for that, which should be maybe 25 times the EBITDA, maybe max 30, the cash flow. This thing is growing at a rate of knots that justifies that multiple. It's really got very little downsides and a lot of capital needed to operate this business. And so if you said 20x the revenues in 5 years, it's a 10x from here in 5 years. And I still wouldn't be selling. I'd be holding this thing over time. If you look at what Texas Pacific has done, it's been an amazing compounding machine. Your return on invested capital has been like 42% consistently for certain periods of time, depending on when you take the measurement. And it's been around for like 200 years. So truly, truly phenomenal. I think this is very similar given the optionality of the land. Another way you might look at it is to value the land. So this is extremely rough, but on the back of the envelope, this thing currently owns 220,000 surface acres across the sort of Permian, Delaware. They cross the state line between New Mexico and Texas. Cell sold 225,000 for 9.5 billion. So, you know, somewhere this thing could be close to that. Okay, somewhere close to that. And I'm not saying that the land is the same. I'm not saying it's going to be valued as that, but it just as a rough guide to see, is this worth further investigation? I think that it is, given that who knows, in 10 and 20 years, they could use a lot of this land for different purposes that we haven't thought of before today, such as Texas Pacific. It was a land, and it was I think, a railroad, and then it was all about the oil there, and then it became, water and gas royalties and grazing pastures, and who knows what. Who knows what's going to happen in 10, 20, 30 years, but the development will likely of technology need land, and this seems to be a prime candidate to be able to transform its business over time and add value. Okie doke. So here's a one pager, and extrapolating out of it 10 years is not particularly outrageous, I don't think, for this type of business. It's fairly consistent. It's a royalty business. These are growth assumptions that I've put in there. You can agree, you can disagree. These are multiples. I don't think they're fairly standard market multiples for this type of company. And your discount rate is plonked in there at 10%. There's arguments that you might make that even lower, given the fact that the land component should keep pace with inflation and population growth over time. But be that as it may, this is what I've come up with. And if you agree, you look at the shares outstanding and look at current revenues and EBITDA that this company can produce. I think that, between an EBITDA valuation and free cash flow valuation, I think this thing, again, is pretty close to a 10x from here. $324 a share, currently trading around sort of 35. And it's all coming back to this idea that there could well be a 10x in terms of upside for this company. So I'm long the stock. It's a multi-bag of potential. It's got liquidity. It's got an accretive track record, although publicly it's got a short history. We can use Texas Pacific as a really good example for what is possible for this type of thing. 7.5% or a max weighting in different portfolios is what I'm going to be building this thing to, because it has such great long-term compounding potential. Thank you very much for watching. I hope you're doing well, and please do like and subscribe to the channel. I look forward to catching up with you in another video shortly. Take care.